small delay there. So I'm running a few minutes behind. Let's just jump right in. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure here. I got back into small path, S, and Palantir. Let's talk about it. Let's talk about the day. Today was a crazy day. You know, all the complaints about the boring trading sessions we've been having recently over the course of the last 2 weeks, where after some opening volatility for the first 30 minutes, we've been going sideways in those tight ranges. Well, today was definitely not that. Yet at the end of the day, while it felt like one of the biggest down days I feel like we've had in a long time, the SPYs here are down only 0.25%. The Qs are down 0.3%, and the IWM took the brunt of it, down 1.8%. So a lot of weakness here in the Russell. That's with the TLT being down 1.4%. So it's a big down day for bonds, a big increase in interest rates today, which, as we discussed in the morning meeting, as soon as the PPI number came out a little bit hot, the expectation was that the IWM would underperform, like we discussed, and then there was further information that everyone should read in Pat's note if they want to learn a little bit more about it. We understand that the small caps and the mid cap companies are just much more interest rate sensitive than the Apples of the world. And it's an interesting dynamic because you could almost even make an argument that in certain spots of the economy, like if you think about an Apple or a Microsoft, that increasing interest rates is actually inflationary, because those types of companies are, you know, they have debt at 2% or so, and now they can receive 5+% on the boatloads of cash that they are sitting on. But at the same time, the increase in interest rates is terrible for a smaller company that's trying to get going, that might be unprofitable, an unprofitable tech company that's trying to reach a certain point where it can just focus on adding scale to then get to profitability. It's a tough time for them. It's a tough time for any individuals who might be in their household forming years where they're looking to buy a house or anything like that, because prices are still expensive, but interest rates are much higher. So it's a really interesting environment, but what that will turn into is relative strength for the mega cap tech companies and relative weakness for the mid caps and the small caps. And like we pointed out in the morning meeting, you can see, like, this just happened with the CPI the other day. The SPYs and the Qs ended up being decently strong on that CPI, and we went over that CPI. The main numbers there seemed like they were a little bit hot, but underneath the surface, it really wasn't too bad. But you could see that the SPYs, the Qs were just fine, and then the IWM had a lot more weakness. So that was the expectation coming into today, with this PPI number also coming in hot. The interesting thing is that traditionally, the CPI seems to affect the market much more than the PPI. The CPI's traditionally, over the course of the last couple of years, created bigger swings, bigger moves, more volatility than the PPI has. But this week, off of the February numbers, the CPI was relatively muted as far as the reaction goes. Strength in the Qs, weakness in the IWM, but it wasn't like a crazy day. Whereas today, the hot PPI, it just felt like a crazy day today. The market was absolutely all over the place. Initially, it seemed like, once again, this market was ignoring the hotness of the number. We had this initial downtick, but it wasn't that bad at all. I remember when we were doing the morning meeting, looking at the Qs, which then were upticking into the market open, saying like, wow, we're only 60 cents away from the starting point in the Qs here. It'd be very possible for us to just kind of get above. And then once this market actually opened, we opened up with this gap up. We still went sideways for the first 15 minutes. And seemingly out of nowhere, there wasn't anything new that hit at 9:45. The market just all of a sudden seemed like it decided it wanted to care about inflation again and the higher interest rates. And then we just got wrecked here for 10 minutes. The 9:45, 9:50 candles were brutal. They were very brutal, particularly with the IWM. And the IWM, we called out that long here at this low on like the fourth 5-minute bar for the bounce trade. I went after the IWM because I was short the Qs. He would have been much better off buying the Qs, which is where the relative strength was, than buying the IWM. But all the same, it was meant to just be like a quick bounce trade. So an attempt of a bounce into the ADMA here, and then the IWM continued its weakness, whereas the Qs, again, where you expect relative strength on higher interest rates, but that's only to a certain degree, right? At a certain point, if the market thinks that interest rates are so high that it can create a slowdown in the economy, then you still will see your Apples and your Microsofts roll over, because then the people who are purchasing their products can't purchase their products in the same way. But the Qs, the most amount of relative strength, again, on this bounce, just very impressive. Nice little downside tail here. Great bounce. And then they were pretty much holding in all day, whereas the IWM was kind of continuing to bleed out. We know that IWM 200 is a big level. So I guess that's the next thing that we should assess. Today, which seemed like a very weak day, which again, SPYs are down 0.3% because going back to the small time frame real fast, you can see just once again, and this is not the first time this has happened on weekdays over the course of the last 2 months, MOCs come out and the market just absolutely rips the last like 10 minutes. This was looking like, for the SPYs, we might have like a decently bearish looking candle here, closing on lows, testing the low from a couple trading sessions ago, which is the CPI day. And now when you look at it, because of that tail, because of the way we were able to rip the last 10 minutes, this just looks like it was just another trading session, maybe a little bit of elevated volume, but this just looks like another trading session in our bull trend. Whereas obviously the IWM looks like a problem. So the question is, what we've continuously been discussing here as a team, is that the evidence right now points to a market environment that is very insulated on small pullbacks, very supportive with buying coming in on small pullbacks, and therefore small dips, basically any dip that is above a major support level, is something that you should be looking to buy, not really short. Though obviously on a day like today, there was probably really good trading opportunities on both sides. But at a certain point, if you break some key support levels, the market environment could very quickly change to an environment where selling leads to more selling. So you want to see at the end of a day like today, today really felt like what I like to call, and what Pat was saying, like a day to take notice of. Like, is this potentially a change for the market? Did something change today? When you look at the SPYs, the answer is very clearly no. It looks like nothing changed at all. We are not near our major support levels. We didn't even really test the 510 momentum support level today. SPYs always seem like they're benefiting from wherever the relative strength is. If the Qs are relatively strong, then SPYs are relatively strong. If the Qs are a little bit weaker, but we get some rotation into the IWM, then the SPYs stay strong. So SPYs are just super strong. They didn't even really test 510. They didn't test this pivot low of 508.50, and they didn't test the more major support zone, which is the space between 503 and 505, basically, where at that point is where I think that we could get a market environment change. Though as we continue to go higher, we might need to reassess those more major levels to be a little bit higher. The Qs have been a little bit weaker. They have not been able to really recapture too much of that bigger sell day that came from AMD and NVIDIA, which is March 8th. And they battled with and lost on a closing basis, again, that 440, which has been an important inflection point. It's been an important, I keep calling it the momentum support level. Losing that does not necessarily mean that the environment is changing to that selling could lead to more selling environment. It kind of just more means that the upside momentum is not something that you could count on necessarily in the same way. But the Qs are still decently above their more major support zone, which is that 434 area, a little bit below 434. The IWM was a potential problem today. So 203 is an important support level on the daily chart. 200 is a really important level now on the weekly chart, but I do not think that the weekly chart can afford to lose at this point. We've looked at this weekly a number of times. You can just see how much more bullish this has gotten ever since we had this inside weekend up a couple weeks ago to get us above and close us above $200. The ADMA on the weekly is now above that $200 as well. You do not want to lose that 200. To the point where I was buying the IWM into the close here. I didn't capture this full move, though I was thinking in the back of my head maybe the MOCs create a bounce because we've seen it happen so often on these weekdays. But I was trying to buy and build into that $200 into the close, even though I didn't have a ton of time left on that trade. And then we, snap back very impressively here, even with the IWM, though it still finished down 1.85%. I guess that's just a little bit better than 2.5% or whatever we were down at lows. So SPYs and Qs, SPYs look totally 100% fine. Qs have lost the momentum level, but not the major support level, so it's not necessarily the end of the world. And the IWM is a little bit of a problem, losing 203, testing 200, but not losing it. So we got to keep a close eye on it because, I don't know, even though when I look at this chart of the SPYs here, everything just looks hunky-dory and healthy and normal, today did feel a little bit different. It felt a little bit different with how the VIX was moving, just the weakness we were able to see in some of these stocks, the heaviness of some of the selling at certain points intraday. Though Apple was able to hold the market up, Google was able to hold the market up. Google had a phenomenal day. Amazon was able to hold the market up. So you had some rotation into a select few mega cap stocks that, really helped this situation. And that's been the theme, though, for a couple of months. This is not the first day over the course of the last couple of months that we've had one of these days that I'm saying potentially matter. There's been a few of them. And we'll see if this time it leads to something different. I think you only get confirmation of that if you lose major support levels, or if by the end of the week, which I guess is tomorrow or early next week, we are right back above these recent highs here in the SPYs, in which case it becomes very hard to make an argument that we're setting up for the breakdown. It's been really impressive to me, and this has been one of the things that we've been chatting about as a team, just how well the market's been handling this bad news recently. It seems like nothing can bring us down. I know Brant was making half jokes about inflation is back, Russia's threatening nuclear space warfare, all the different problems that are going on, yet the market continues to ignore it. One thing that I have learned, and the guy Jem Carson really points it out with some of his work, is the importance of market dynamics, where sometimes it's like, I don't know, what's the saying, the straw that broke the camel's back or whatever, that last bit of weight is what potentially can break the market. It's like sometimes sometimes the way the market seems to work is that you have all this negative news, and that's like that added weight that's building up on the camel, if we're trying to use that analogy. And then sometimes I think the straw that breaks the camel's back is not necessarily like a new piece of information. It's that the market environment is able to change because of something like an OPEX that can loosen the market a little bit, and then all of a sudden selling leads to more selling, and then all of a sudden the pundits on CNBC will start to bring up all these reasons why the market went down, even though those reasons have actually already been in existence for days, weeks, or even a month or two, as their only excuse, because it seems like, at this point we know CPI a little bit hotter, PPI a little bit hotter, we're not anywhere closer to 2%. The gap between increasing interest rates and where the market has been rapidly increasing. All this stuff is building up, yet the market just can't seem to break down. We need to keep in mind, and this was actually one of the things, I don't think Bill is here. I think he's away today and tomorrow. But he was providing just some information when the CPI hit about this Wednesday VIX expiration. So this Friday OPEX is really important, but typically the options on the VIX, the expiration is the Wednesday before, and this week for whatever reason it's the Wednesday after. And historically, what this just does from a positioning perspective is it really dampens down vol. And when you dampen down vol, it is very hard for the market to actually break down. So one thing that we should keep in mind is tomorrow is the options expiration day. Wednesday is expiration day, and then Wednesday afternoon is also the Fed day. Is that those expirations could potentially create the market environment change that allows the market to all of a sudden care about all this stuff that we're kind of scratching our heads about how did the market just rally so well in those last 10 minutes today to save the SPYs once again, and to have the SPYs only be down 0.25%. I always say respect the technicals first and foremost, but we want to know this other information. And what I've been saying here, I've become significantly more bearish on this market starting a month ago, but that bearishness hasn't cost me any money because I recognize what I've been telling you guys, which is the trend is your friend, and trends tend to stay intact for much longer than people expect. I expected the market to lose this trend, and losing the trend doesn't necessarily mean a 20% pullback. It doesn't even necessarily mean a 5% pullback. It can just sometimes mean sideways price action or maybe a little bit of a deeper pullback. I expected this market to lose this trend and honestly to give us at least some sort of minor pullback a month ago now. And yet the market's been able to be super resilient. Something's always saving us, whether it's AI or the MOC price action saving the technicals. But the trend is your friend. That trend continues to troop higher here, and we need to respect that. At the same time, we want to pay attention to all of this other information that seems to be negative as it piles up on the camel's back, and just in case a positioning difference in the market that can stem from OPEX and expiration could be the straw that breaks the camel's back that enables us to pull back deep enough to actually hit those points where selling could lead to more selling. Because as much as today felt like a day to take notice of and a day that was in some ways super bearish, the market rallied massively in the last 10 minutes of the day. And like I said, we're down 0.3% or something like that at the close, which is absolutely nothing. So, I think that's kind of the big picture after today's trading session. It was an exciting day. There was a lot going on. We had good price action today on the small time frames that led to some good trading opportunities, good opportunities to buy some of these extension dips, good opportunities to, I think a short was called out here as well, which was a good shorting opportunity. You could take that in the SPYs, you could take that in the Qs. I was trying the longs in the IWM, even though it was relatively weak, because whatever. That's just a tougher trade. Go after the relative strength. Rex, if he's here listening, does a great job of that. When I'm calling out the long in the most relatively weak thing here, the IWM, and I'm like battling to make a few dollars in this, which I did, he's like, okay, I'm gonna buy Google off like the same pivot low. I think it was Google. Rex, if you're listening, you can correct me if I'm wrong. But he was like, okay, Derrick recognizes the market low is Microsoft. Derrick recognizes the market low to come in and buy. So instead of following him in relative weakness, I'll be smarter than him and I'll buy relative strength. I mean, and if you went after, if you only look at Apple, Microsoft, and Google, if you only look at the 5-minute charts today and you know nothing else, you would think that today was a massively strong day. I mean, where did these things close? Microsoft is up 2.75%. Apple's up 1.3%. Amazon's up 1.3%. It's incredible that the Qs are negative at all when you look at those three names. But wild day. Some good trading opportunity. I guess as far as individual names, I don't have too much to talk about. Tesla gave great downside follow through for the people that are still short with me from yesterday. I tried this GEO long this morning, but I took a small loss in it. I couldn't get any traction in this thing. I thought, nice breakout here versus this 12 quarter to 1250 area. looked pretty good, but again, just no traction on it. I mean, it held up okay considering just how weak a lot of these types of names were. And that was pretty much it. Outside of that, just trading the market, trading the Qs, Tesla, trading the IWM via TNA. I traded a little bit of Apple when it reported that AI purchase that they did. Made a small amount of money in that, but liquidated the position. And that is all that I've got. So I am happy to answer any questions that you guys may have. Let me scroll up here in the VTF. First thing I'm seeing is from David B. I'm rereading Mark Douglas's Trading in the Zone. Great book. He talks about installing a belief. For example, the belief that one is a consistently profitable trader. He talks about having experiences that confirm this belief. His plan for accomplishing this with profit taking aligns with what you describe in your game planning class, booking profits on the way, covering risk. Do you believe learning a new type of trade or trading style involves any similar exercise of calibrating belief with experience? And if so, how do you approach it? Yeah, so great stuff, David. It's a phenomenal book. I've read it a couple times, though I must admit it's been years since my last read through on it. But phenomenal book, one of the best trading psychology books that's out there, and I recommend anyone to read that who has not already read it at this time. So your question here is basically you are taking some market psychology principles that come from trading in the zone, and you are trying to apply it to a trader who would be branching out to learn another trading style or a new type of trade, and asking if it's a similar exercise about calibrating belief with experience. And my initial answer is absolutely yes. And I think that this goes back to a little bit on, I don't remember whose question it was yesterday. It might have been Vincent's question, but we spent a lot of time talking about building an edge or coming back from like a really big loss and being able to improve from that. And we talked about if you're coming back from a really big loss, to start small and to build your confidence by getting your P&L right in a small way and then add on to it. I think it's the same thing when you're trying a new type of trade or a new trading style. There's going to be a big learning process there for you. There's going to be a trial and error process there. You're going to make mistakes. You're going to make adjustments to your rules that define that new trade or that new trading style. So the way that you want to approach that initially is by starting small, building in, testing your rules, making adjustments as necessary, and then as the success comes in, that also will increase your belief in yourself, I guess, for lack of a better term. Your totally blanking on the word that I want to use, but basically your belief in yourself. And then as your confidence, that's what I'm looking for, as your confidence grows, then you can continue to work on adding additional scale onto that. So I think that your confidence or your belief, as you're saying, goes with the experience of implementing that new trade and trading style, starting it small and recognizing that adjustments will need to happen. Thanks, David. From Cold Smoke, maybe it felt like a day to take notice of despite the marginal drop in the SPYs and the Qs because a few of the big names that are heavily overweighted in those two indexes keep those up. Yep. The vast majority of the names across sectors got hammered today. 100% correct. But that's one of those interesting things. Basically, it's a breadth comment that you're making. There's a belief in trading, I think, and in markets that statistically, at least over the course of the last 25 years or so now, has been proven to not be true, which is that poor leadership is a signal of a market that's going to break down, meaning you seem to be 100% correct. It's Google, it was Apple, it was Amazon today. It's a little bit different than when it's usually NVIDIA. But it was Google, it was Apple, it was Amazon that held the spies and held the Qs in, and it makes that spy chart look okay when there's a lot of stuff out there that got absolutely hammered and was gross. But what we have seen historically is probably just as often as poor breath eventually means that you lose the leaders, and once you lose the leaders, which is the only thing that's holding the market up, then everything gets destroyed. About as often as that happens, the opposite happens, where those leaders hold the market up, and then eventually everything else catches up. I don't think that there is any historical indication that one has to happen over the other. So what does that mean to us? Well, I think that means to us that when we're thinking about smaller amounts of leadership or just a few companies holding the market up, you want to think about all the other pieces of information, all the other circumstances that are out there to try to decide, well, in this situation now, what is more probable? What is more probable now? Is it more probable that, and this is what's been happening more recently, every time the leadership has been, very few, everything else begins to catch up. Is that more probable again now? Or is the opposite more probable, where this time not everything catches up, you eventually lose leadership and everything sells? I'm actually inclined to think that the market right now, the second situation is more probable. That this time around, which has been very different from the recent times, that once we lose these leaders a little bit more, then we really lose everything, and selling leads to even more selling, and it's selling across the board. I've been hoping that we could lose leaders and just have mean reversion with the IWM catching up, but seeing how the IWM traded today, it makes me very nervous, because I think that if you have continued weakness and the Russell loses 200 and then eventually these other leaders actually lose their strength, then I don't know, it could be really bad really quickly. So we just need to be prepared for that. That was kind of the whole gist of the first part of my meeting today, where I just want to remind everybody that the spies and the Qs look good, but we could lose some levels here, and it could become violent on the downside. So we'll see. Thanks, Brian. For Mike Reed, I was looking to enter Hood. What Hood is it? At 8:30 Eastern Time, I assume. Okay. Your Robinhood, excuse me, very strong. Very strong this morning. Very strong after hours yesterday. I think it was just getting boosted up by analysts and their crypto business and everything else. So you're looking at a name that's in play. You're looking at a name that's strong. You're looking at about 8:30 in the morning to buy the break of a 30-minute shooter. So 2 inside 30s in a row. I actually don't have a 30-minute chart available for us to look at on this chart that I have built out here. So we can try to look at a 15 to get an idea of what you're looking at here. Okay, so I can see that this acted as 2 inside 30s in a row potentially, and you're looking for a break higher. The ADMA had caught up on the 15, and it was tight risk, looking at the 826 stop. 1826 stop. Why 1826? 1826 down here. Am I missing something on the daily? Nope. Okay. I didn't love the trade, but I thought the morning news was reasonable on it, and it was showing relative strength to the market at this time. The market was in a sideways-ish grind, sort of lower highs and lower lows, and I hesitated a little because of that. But I also had a few small wins and didn't want to give back the green P&L. 11:30 Eastern. Gotcha. I was wondering. I assume you meant Eastern because we just always talk in Eastern because everyone's in different time zones, and Wall Street is the financial center of the universe, so I always go with Eastern. I'm on Mountain Time. You're on Pacific Time. Pat's on Eastern Time. So we're all Elliot, if he's listening, You know, he's in Israel. Who I don't know. I have no idea what time it is out there. Okay, so let me re-review now that I know that you're talking about actually 11:30 Eastern. Okay. Okay. Yeah, I can see it here on the 15-minute chart. I like this. And this wedge on the 15-minute ADMA is catching up. You're looking for that break higher. That all looks great to me. Market's not really on your side, you're telling me, but at that time of the day, if I remember correctly, it wasn't necessarily against you really either. It was probably an environment still because we were below that 945 low where you're better off leaning to the side of the shorts and the longs, but not the end of the world because you're trading a name that's relatively strong and is in play. So you're not like really fighting the market so much with this. So you hesitated a little bit. You didn't want to give back your P&L. You don't want to trade your P&L though, right? You want to trade the trade. If it's a good trade, trade the trade. Was just wondering if you had any suggestions on how to overcome these demons. I would have gotten my risk covered and then trade ended up not working, which would have been fine with me. So I assume that what you're really talking about here when you're talking about suggestions on how to overcome the demons is your hesitation on taking the trade because you're up a little bit of P&L. That's a really hard one. I think it goes back to a little bit of what I also talked about in yesterday's afternoon meeting, where one of the hardest things for me over the course of my career, one of the things that took me, and there's a couple things, but one of the things that took me more time than almost anything to get through with my head was that my P&L really doesn't matter. But not just to say that, to actually feel that way, to trade the same, whether I'm up $10,000 or down $10,000 or anything worse or better or in between. And it really, really took me years and years and years and years of experience to get the degree of confidence, to go back a little bit on what David B. was saying, to get the degree of confidence to trade my trades regardless really of where my P&L is, as long as I'm not violating my risk rules specifically. So that's what you need to get to. Any suggestions on how to get there? Oh man, that's a really hard one. It's probably just the usual suspects: time in the seat, time in front of the screens, experience, and you can amplify that experience by doing things such as journaling and participating in our afternoon meetings and maybe getting a partner that you can review trades with and reviewing your trades again yourself and just, reinforcing all the things that you do right as a trader to continue to do them and recognizing the things that you do wrong so that you don't do them anymore. And, this is just one of those things. You're up a little bit of money, that's fine, but you're probably not in this business to just make a small amount of P&L, right? So you have to be willing to give back those few small wins in order to have your day become significant, because this also then circles back to, we haven't spoken about it in a while, but we've talked about it in afternoon meetings about the importance of risk management when you actually study what a trader's account looks like. Because when you study what a trader's account looks like, I know we've gone through this exercise, it's usually the outlier days that make or break an entire month's worth of trading. It's the 2 to 3 trading sessions where you completely violated your maximum loss in the day and took a significant loss that's beyond that will absolutely ruin your entire month. And also, what I really think successful trading often looks like is, if you take a trading month, which typically has like 20 days or so in it, assume that 13 of the 20 days, I'm making the number up a little bit, assume that 13 of the 20 days at the end of the month are actually irrelevant. Like, you made some money, you lost some money, you weren't at your maximum loss, you didn't crush it, that they were irrelevant. Then of the remaining 7 days, maybe you had to have 3 or 4 days in there where you, let's call it 4, or even 5. Let's say 4 or 5 of the remaining 7 days where you actually hit your maximum loss and shut down for the day but didn't exceed it. And then your remaining 2 to 3 days, you crushed it by making a multiple of your maximum loss. At the end of that month, all that matters is the 2 to 3 days of the entire month where you actually crushed it, and you probably have a positive month simply because of that. Whereas if you had of the few days where you stopped at your maximum loss, if you had bad discipline and you didn't, then all of a sudden you lost a multiple of your maximum loss, and even with the few good days in there, your month is break even to losing. And if you didn't ever have the 2 or 3 really good upside days that are a multiple because you stopped from pursuing successful good trades that are within your edge every time you see yourself up a little bit of money, then you're having really bad months. If you are, losing multiples of your maximum loss on a few trading sessions, but never having a day where you make a multiple of your maximum loss because you're stopping every time you see some small green P&L. That's actually the worst situation that you can be in. And everyone's got their own issues on what holds them back, I think, from bigger P&L and more success, but it tends to be a combination of either they have those few trading sessions every single month where they lose significantly more than they were supposed to, or they have a few sessions every month where, or I should say they don't have the few sessions every month where they're making the monster P&L, or a combination of the in-between. If your P&L is in the neutral range, meaning, let's make up some numbers. Simple numbers. Your maximum loss is $500 on the day. You're not supposed to lose more than that. If your P&L is between down 400 and up 400, you should realize that your day is completely inconsequential. And honestly, if that's you, the difference between making $400 and making nothing on the day is honestly, it's irrelevant, because those are the days that are in the first 13 days that I'm talking about, where it's like you made some money, you lost some money, it all washes out, it doesn't matter. What really matters at the end of the month is stopping yourself and never letting yourself lose more than the $500, and then having 2-3 trading sessions, ideally more, but 2 or 3 trading sessions where if 500 is the maximum loss, you made somewhere between 1,000 and 3,000, maybe even 5,000, and then you're making money. So you have to recognize that, right? You have to recognize that the small wins that you had from a few trades earlier in the day that you were concerned about giving back are pretty much literally meaningless. It's not going to matter at the end of the month whether, again, let me use the same numbers. So if your maximum loss is 500 and you had a few small wins, maybe you're up $300 or $400 on the day. It's irrelevant. You have to take that next good trade that is within your edge, because you want to try to push that day where you're up small from a few small wins to actually being one of the days that's significant. And I would argue that you are better off giving back the $400 and closing at zero on the day than stopping yourself from trading and keeping the 400 and never realizing the potential of that day being a, $2,000-$3,000 day on the upside. You need to go for it. So maybe just the way to get through that, and this is maybe the way I've gotten through a lot of my hurdles over the course of my trading career, is now that the market's closed, to just rationally think about those things and recognize what I'm just saying, and then next time it comes around, just continuing to trade properly. With all that said, there's just one other point that I want to make. I do believe in something we don't talk about too often, which traditionally we always called a limit up-down. So limit down is the same thing basically as your maximum loss, right? So that's $500. But a limit up-down would be you're having a decent day, right? You're up, let's say you're up $500, so it's 1-to-1 on your max loss. That's a fine day, it's kind of gravy at the end of the month, but you'd rather be up $500 and down $500 at the end of the day, obviously, right? So the question that you should be asking yourself when you're up like an okay amount like that is not, should I not take this trade in Robinhood? The answer should be yes, you should take that trade in Robinhood. The question is, how much of the day that I'm up am I willing to actually give back in order to have my $500 day become a $3,000 day? And we call that the limit up down, right? So maybe the answer is zero, right? Like, I'm up that $500. I know that this is not really going to move the needle for me at the end of the month, so I don't want to stop trading here. But at the same time, I'm not going to allow myself to turn a winner into a loser. I'm not going to allow myself to turn a positive $500 day into a negative $500 day. So I will stop myself out if my P&L gets to zero. So I'm willing to risk the P&L that I made on these few trades because, again, in the big picture, it's inconsequential on the account, and I want to make it consequential. But I'm also not going to be willing to give this back to like a maximum loss day either. And that's something that I think is a really good money management rule or tool that you can utilize as well. I hope that helps, Mike. Appreciate the question. Continuing to scroll down in the VTF. Thanks, Rich. From Carol, I was trying to go long the IWM, but it was very hard. Better would go with the Qs. I agree. But I like the idea of the IWM given the pivot with the swing opportunity. Problem is it might be too early. Yeah, it's better to go after relative strength like we were talking about earlier with Rex. From Chris K. To add on to David's question, I've heard some people say that you need to back test. You need a back test of 30 trades. Some people say 50. Some say 100. Any input on that? I don't believe in back testing, which I say that sometimes and it blows people's mind, especially like if they haven't been in the business. I don't believe in back testing. I don't believe in back testing trades. Because a trade has worked in the past does not mean that it's working right now. It does not mean that it's working in the future. So you're better off like forward testing basically, which means that you are testing by actually trading those trades in real time than seeing what they did previously. And you do that, going back to David's question, you do that by trading very small with inconsequential P&L to see what the results are as you adjust the rules. You might back test a trade 10 years starting in, I don't know, 2020. And then guess what? The market environment went through a huge change in 2020. It went through a huge change with zero DTEs, and that trade doesn't work at all. So I don't back test, and honestly, most of the best quant traders I've met don't back test either. And those are quant guys, right? Who are automating robots to actually trade these strategies. So slightly different than our discretionary trading, but also a lot of similarities as well. So I think it's more about what we were talking about. It's about learning that new trading style, implementing it into the market in a small way, building rules around it because the rules create consistency like we spoke about yesterday. Making adjustments to those rules as you're garnering more information based on the trades that you're taking, honing in that edge, seeing it get cleaner, and then adding scale to it. Thanks, Chris. Scrolling through here from Carol, what part of position I should leave as a runner? I struggle to leave a runner and take profit often too early and not let it run. Sure. So I think it depends on what type of trade that you are taking. So very broadly, we can categorize any trade that you take into like 2 to 3 categories. Either the trade that you're taking is with the trend, it's against the trend, or it's part of a range-based system. So with trend trades, like we talked about when we were looking at the SPYs and the Qs, have the benefit of being with the trade, with the trend, which means that they tend to be easier. They tend to be more forgiving on mistakes. They tend to fail less often. They tend to have better risk-reward profiles because the reward profile on a with trend trade can be relatively unlimited. And when you're with that type of trade, when you're with the trend, it makes more sense to leave a larger percentage of your position as your runner, if we want to use that term. I use that term sometimes, but I honestly don't love it because I think runner implies that you have a very small amount of stock left. But when I'm with the trend in situations like that, my runner, if we want to use that term, could be anywhere from 10 to 50% of my position. 10 to 50, 50, half my position. Counter trend trades tend to be more difficult and they tend to fail as a rule. When you are taking a counter trend trade, when I was buying the IWM today as just an example off of this low, my expectation was for the trade to fail. So why take the trade? Because even though my expectation is for the trade to fail, I can still make money on counter trend trades if I'm a sniper and I pick my spots and I have a good game plan and I'm not too greedy with it. So I'm planning on being out of the majority of my position if I can just get it bounced into the equilibrium area, and I'm not looking to add back on the way down in the same way that I might on a with trend trade, and then I'm expecting to get stopped out, which is what eventually happened. I probably got stopped out of the last, I don't know, 15% of my position, 10% of my position, something like that. Yet, we also want to analyze, we talked about this in yesterday's afternoon meeting a little bit, trends on multiple time frames. Because this trend might be counter trend on a 5-minute chart, but it might be with trend on a big time frame chart. And therefore, if it's counter trend on the small time frame, but with trend on the big time frame, you have a much higher probability of a reversal. Therefore, you want to keep a larger percentage as that runner. Just in case, even though with any counter trend trade, the probability is that it will fail, just in case that retracement actually does become a reversal in the lower probability situation. And it's a less lower probability situation if it's with the big picture on the daily chart. So again, on a with trend trade, I might look to keep anywhere from, I don't know, 10 to 50% of my position. On a counter trend trade that's with the trend on the big time frame, maybe 10 to 30% of my position. On a counter trend trade that is also against the trend on the big time frame, maybe 0 to 20% of my position. Is the way that I would think about it. So it's based on probability of continuation. Highest probability of continuation if the trend was with you to begin with. Little bit less if it's competing trends on competing time frames. Significantly less if it's counter trend on every time frame. So I hope that helps. From Vikas, I found doing this useful. I have a small runner position and a larger intraday position. So if I am winning intraday, I keep some gains, and my runner takes into account overnight risk because it's smaller. Yeah, so that's a lot of what I am a proponent of also. I'm a big fan of swing trades basically starting as day trades and then having that, whatever the percentage is that we just kind of went over with Carol's question. And then if it closes well and you've got a decent profit cushion between open P&L of where it's closing and what you've closed out already, then swinging that position to look for the further continuation. Love the idea, Vikas. Are they, Mike? Wow. I should adjust that. You're the first person I think that's noticed that. Yeah, my afternoon meeting says it's March 14th, 2023. Did I never change that on that? I have like a form sheet that I go to for every meeting. Interesting. Thanks. I'll try to fix it for next time. From Jim, I also struggle with the P&L swings and always have. It's a work in progress. Learning how to scalp has helped smooth out the psychological impact and my ability to recover losses relatively quickly. Okay. Yeah. Again, I don't really have anything else new to add, except that is one of the most difficult things that took me personally years to get through. Josh's comment cracking me up. From Cold Smoke, Brian, this is the psychology in trading. I have got to the point here where there is a large gap between what I know I should be doing and what I'm actually doing in my trading. I'm actually seeing a behavior and cognitive therapist to help me work through this. No something and no shame. Yeah, no, I love that, Brian. Obviously just want you to be super successful all the time, but it's absolutely a journey. And what you're describing is I think I even talk about these like 4 stages of trading psychology in one of my standard YouTube videos, which if anyone can find it, it would be cool if you posted it. Um, but if I remember correctly, it means you're kind of in that third stage, right? It means that you've basically gotten through all the learning, you've gotten through all the mechanical learning, you understand what markets look like, and yet you stand in your own way of your trading. I definitely definitely have been at that point at various parts of my career, kind of coming and going also. And that's, one of the hardest parts to get through, to be honest. You have to get through that part to really become a successful trader, and it's difficult. And, I can really only obviously describe what has helped me in my journey. Uh, but it's being able to take kind of that step back, which is difficult in real time, to remind myself. It's the same thing I say all the time. It's that same mantra all the time. I know how to make money. I know what my edge is in the market. I know what the right things are to do. I know what the wrong things are to do. All I need to do in order to be a successful trader is to do the right things consistently over time. It's such a simple statement, yet such a difficult statement to actually implement. All I need to do in order to make money, in order to be a successful trader, is to do the right things consistently over time. And I still fall away from that. I still make mistakes. Progress is in having those days where those mental lapses occur that lead to those mistakes happening less and less and less frequently. I don't think that it will ever 100% go away. But I think for me, there was a time in my career where what you're describing was a weekly thing, where there'd be at least once a week where I was, getting in my own way and not doing the right things that I know are the right things. And over the course of, years of working at it, um, now it might be like a once in a quarter thing for me, or maybe a little bit more than once in a quarter, but I want to think a little bit less than once a month, if I'm being totally honest, somewhere like that. And then part of it also is that at this point, when it does happen again, I'm super hard on myself, because I'm like, you've been doing this too long to be letting yourself do that and make those mistakes, and trading in the way that's not your edge, and not doing the right things consistently over time that make you money. So that's absolutely a really difficult part of it. Um, cool. I just lost my spot in the VTF here. Anyway, I found it again. Mike Reed's comment to Brian: I've done a lot of work around exactly what you're saying. I've gone from taking trades off the open and hitting my max loss quickly to sitting on my hands and trying to be very selective and actually seeing and going through my checklist before I consider the trade. Derrick has said something in yesterday's meeting that had kind of reinforced what I'm doing, and that was, your job as a trader is not to make money. Making money is the result of your job. Yeah, that's one of my favorite sayings that I've come up with about trading. Your job as a trader is not to make money. Making money is a result of your job, and your job is to, again, do the right things in regards to the market that are based on your edge consistently over time. And that is really the key to it. Eventually, and I appreciate you for sharing, Mike, because what you're describing here is also part of a trader's journey that I remember being at myself as well, where you're kind of going through that checklist. Eventually, over time, as you gain more and more experience, you internalize that checklist so that it can be like a instant thing, like as fast as your eye can blink, that you're able to recognize everything that's in that checklist in real time in that moment and be able to execute on it. And then that will make you a much better trade, because it goes back to what I was talking about also, I think, yesterday, about how the best trades oftentimes only give you one opportunity to be able to get that stock. So you need to try to internalize those things so that you can be fast in your decision making to be able to get good stock and good trades. Cool, great stuff. David L. giving the link here. Yep, that's the one, the 4 mental stages of trading development. Only 42 likes? Come on, guys, get in there and press the button. Popping over to YouTube from Sebastian. What do you think of being an aggressive buyer of Netflix and Microsoft at the Open? I mean, Netflix is just a beaut. We talked about Netflix today. I like Netflix a lot. If that's an inside and up with an upgrade this morning, I love the idea of being an aggressive buyer of Netflix right off the open. I hope this move was big enough for you to cover your risk. And then the market was super weak. Plenty of stocks were super weak and the trade failed. But I totally love that off the open Netflix trade today on the inside and up. And the risk looks like it's appropriate also. Microsoft, that relative strength is incredible. Yeah, this is the other one. This totally broke out on the daily chart. This is exactly what you want to be focusing on. And there was no way in the first 5, 10, 15 minutes of the day that we could have known that the market was going to fall apart the way that it did. If anything, you should be assuming the opposite because of how well we were kind of holding in. And you're going after relative strength, you're going after breakouts, you're going after beautiful charts, you're doing it off the open. I love that style of trading. I think it's a great job. From Gabriel, did you get into the Affirm short? I didn't. I was lamenting that in the VTF today. Man, I typed it up. A lot going on off the open. When I typed up Affirm, it was at like 37.10, I think. And it was going straight down, and I loved it. But the high was 38.57, and I was like, I really don't want to come in here and take $1.50 a risk on this thing, so I'm not going to get in it right now. And then I missed this trade. I really, really like that Affirm short. So I hope you caught it. You missed Upstart. Oh, yeah, you were looking at Upstart more, I think. Yeah. We can't catch them all. Twilio looks like Tesla on March 4th. Tesla on March 4th. Oh, yeah, that first breakdown there. That was a short call out day. Yeah, a little bit. Twilio not looking great. Cool. We'll keep an eye on that one. Thanks for bringing it to our attention. All right, everybody. Looks like I got through everything in the VTF and the YouTube. Great afternoon meeting today. If you're in YouTube, press the thumbs up button for me. Have a wonderful night, everybody. Thanks, Brian. Talk to you soon, guys.